Okay, so I am with Daniel Foch, Mr. Real Estate. Dan, I feel like you wear a lot of hats in the real estate world.
Yeah, too many, honestly.
It's actually hard to keep track of all the stuff you're doing. But we're going to talk about this really cool missing middle event that you have coming up. We're going to talk about missing middle housing today and whatever else comes up. But before we get started, just give us the brief overview of all the stuff that you're up to, because I see some AI thing. I see you with your capital land bank or something. I see you on the podcast that you have, Canadian Real Estate Investing Podcast, sales. So just give us a brief overview of all the stuff you're up to.
Sure. Yeah. I mean, I'm a real estate broker, and my partner Nick on the podcast is a mortgage broker. So kind of just involved in all levels of, like, we just wanted to make it our goal to be a one-stop shop for real estate investors. And so we do stuff on the lending side through Nick. We do stuff on the brokerage side through me. And then the brokerage that I'm at is Valerie.ca, which is Canada's first AI real estate brokerage. So we're doing some cool stuff in that space. So I hold the chief real estate officer role there. And that probably takes the most of my time, to be honest. Like that's my real job. And then I host Canada's #1 real estate podcast, the Canadian Real Estate Investor, where we serve an audience coast to coast, doing very much what you guys do, but just more across Canada than kind of like your Ontario focused investments. And I would say that's about it. I do like a lot of consulting work for research and consulting work. That's really just more like I consider that part of my real estate broker job. I consider pretty much everything we just said part of my real estate broker job, which is, how do I become the most valuable real estate broker that a person can work with? And everything that I just listed is kind of within the scope of that. And the event that we're putting on is sort of just it's similar to what you guys do, right? So I mean, I guess you're a rock star. They're not unfamiliar with the idea of someone who wears many hats, and but similar to the events that you guys do, we're basically just running a full educational event. So it's a 1-day event that teaches people how to develop and build missing middle housing in the greater Golden Horseshoe. So basically from Toronto all the way down to Niagara. And we're doing it with a guy named Al-Karim Davani, who's started Middle and also Round Square. He's probably one of the most reputable missing middle developers in the world. And so we're really excited to have that opportunity to be doing that with him.
And then you tweet about every 5 minutes. I
tweet pretty often. Yeah, I spend a lot. I spend probably too much time on Twitter, but it is what it is.
I was going to say your screen time must be absolutely ridiculous.
I kind of go through waves. Like there's times when I'm much better at regulating it, to be honest, like where I would just spend like a couple of hours a day. But the current 2-month period of my life is not one of those times. It's definitely you go through like kind of a period where you get pretty hooked on it, and then I think you kind of scale it back a bit. You realize, and you scale it back a little bit and try and leave your phone in the office or whatever. Usually, like when the weather's nice, I'm like pretty good at that. But when the weather sucks, it's like, what else am I really going to do? And also like my studio and my office is in a detached garage, so I'm not super compelled to like it's got a heating system, but it's not Canadian winters are tough, especially this one. So it's, I'm not always super compelled to make the trek out there to so my phone ends up in my pocket more than I'd like it to, I guess.
Yeah. More of a 3-season office than a 4-season, eh?
Yeah, for sure.
Cool, man. Well, yeah, I'm in one of those scale back periods myself, but it's tough with all the election stuff going on to not tune into that personally. But okay, so this missing middle event, why are you guys doing this? Why are you placing importance on this? What's the point of doing this in the first place? Like, why do you see this as important?
Yeah, so I think, I come from a weird real estate background. Let me answer your question first, and then I can kind of contextualize it. The reason we're doing it is I've sort of determined that missing middle is pretty much the only actual way that people can make money in real estate in Canada right now, to be honest with you. And maybe you could still buy like your onesie twosies and like, cash flow in some like really fringe markets in Canada that you might not want to own property in, or that there might be some like market risk in. But if you actually want a strategy that you could basically take and move across any city in Canada, including like the 416, like Toronto and the 905, I think missing middle is pretty much the only way to do that. So that would be the reason that we're doing it, is to educate people on how to execute on this brand new investment strategy, and also what I feel is probably the only one that actually is working right now.
Okay. Can you describe what the strategy is for somebody that might not know what we're talking about?
Sure. Yeah. I mean, most people would know it as like infill, basically, right? So it's, you take a small or maybe it would be an oversized residential lot, but a small lot from a development perspective. So, like a, quarter of an acre, 50 by 150, like lot in a, the most common type of lot that you can find in any city in Canada. And you build anywhere from 2 to 30 units on that lot. That's kind of what it is.
And that's that middle housing where it's not single family, duplex, triplex, quadplex, and it's not large scale apartment or condo buildings. So it's kind of that middle scenario, which we don't really see a lot of. So why is it that we don't have a lot of that type of housing?
Most of it would have just been like exclusionary zoning, right? Like basically in Toronto, like in the 1920s, they had a huge migration from Europe due to the wars. And basically the municipal government said, okay, well, the easiest way for us to control which areas sustain their single family residential character would be to make it so that you can't build anything other than single family in all of these areas. And for 100 years, that basically stayed the way that it stayed that way. And many cities across Canada did the same thing. The only areas where you really see middle housing done at scale is like Montreal, which kind of developed quite a bit earlier, and Quebec City, which developed significantly earlier. And that was, back in a time when they were limited by engineering and construction capacity to not build anything taller than 4 stories, right?
So you're talking about Montreal, like how Montreal kind of has that classic European housing where it's like 4 or 5 units or 4 or 5 stories, on either side of the street, almost like a London, European city, right? Where they have like basically like stacked apartments.
Exactly.
Yeah. Interesting. I've never actually thought of it like that. But yeah, Montreal does have that vibe. Quebec City has that vibe. Toronto does not have that vibe. No. It's just newer buildings or maybe industrial buildings that like have been converted to those types of properties for the most part.
Yeah, for sure. That's what you get in Toronto. And then I would say, most recent type of housing that we had produced in Toronto, let's call it would be, or most of the GTA would be, you have two housing typologies. You have McMansions and then you have shoeboxes, right? So you have like your super small condos and then you have your big houses, and there hasn't been anything in the middle. And that's what we need in order to create affordable housing in Canada.
Who's building these McMansions? Just people have the money for it? Wealthy Torontonians?
Well, there's a lot of foreign capital. Like a lot of people think like when foreign capital comes to Canada, or like PR, like new Canadians, let's call it, they come to Canada, they want to live in density concepts, but they don't realistically, right? Like a lot of them want to live in Canada so that they don't have to live in the density concepts that they lived in the countries where they came from. And so, you see a lot of single family detached subdivisions going up in Brampton and, Mississauga, in Markham as an example, right? And there's huge pieces of land, hundreds of acres that are being all basically totally homogenous, like 4 or 5 bedroom homes. I would say, for a lot of that, it's like wealthy families, a lot of people who have like even domestic Canadians who have maybe their parents have equity and are helping them to purchase a house. But a lot of it is kind of your high net worth new Canadians. Yeah.
And that's also what they've seen of like America their whole lives, is these big single family homes. Mm-hmm. So that's, I guess, probably what they want when they come here. With the missing middle stuff, why do you like the numbers? Why do you say this is like your favorite strategy in Canada right now with real estate?
Yeah, so let's just use Toronto as an example. So in Toronto, you can build a fourplex with no development charges under their new EHON program. So immediately you have a huge competitive advantage against the condominium building that's going up next door just on development charges. I actually mentioned this at the Rockstar event when I was on that panel with Sasha. But so your land cost is higher, right, on a per unit basis because your density is lower, so you can build fewer units. Although now in the city of Toronto, they have this program called Major Streets, which I would encourage everybody to look up and we're going to do a lot of information on the Major Streets program in Toronto at this event. But Major Streets will basically allow you to do up to 10 units with no site plan approval as long as located on a main road, and up to 30 units as of right, but with site plan approval, and up to 6 stories in development. So that's like your middle housing that we're talking about, right? Now with those ones, you would have. Sorry, go ahead.
That's something that's already passed, or that's in the works?
It's in the works. Yeah, it's in appeal right now, but it's actually an appeal because people appealed it because they want more density from it. So,
oh, that's good.
Yeah. But yeah, so with those, you'd have to pay development charges, but they still, again, you're taking you can buy a decent sized lot on a major arterial road in the city of Toronto for, low 1 million, it's probably $1 million. Let's say $1 million land cost. So, and the fourplex site would be the same thing. So let's say you can get a piece of land in Toronto that you could do either of these concepts in, for $1 million. You can either build the 10 units, with no site plan approval if it's on a main road, or you can build a fourplex. And a lot of people are doing this thing called the 4+1 right now. So they'll do a fourplex and then they'll later add a garden suite. And then that allows you to get CMHC MLI select financing, which we'll talk about afterwards. But 4 units with no development charges, which reduces your cost. Plus your construction cost is significantly lower. Like, let's assume you're going to rent this out and you're competing with a condo. A condo costs, I don't know, probably $1,000 a square foot in total creation costs. Really, that's why nobody's building them, because they can't sell them for, they can't afford to build them unless they can sell them for $1,200 a foot, and nobody's buying them.
And that $200 difference, that's just all the margin that they need to basically make it viable.
Let's say that. Yeah, that would be their profit. Yeah, which is 20% margin over a 6-year. I would say that's reasonable return expectation for them.
Hey everyone, I wanted to quickly share my personal journey with the Rockstar Inner Circle. I joined Rockstar when I was 23 years old because I wanted to learn how to invest in real estate, and I was looking for the right people to guide me. What I didn't expect was how much more the Inner Circle would give me. It's not just about investing, it's about being a part of a community that is genuinely invested in each other's success. I've learned so much here, from real estate strategies to understanding the economy, personal finance, and how the whole money system works. I've gained the knowledge to build my own business, create my own assets, and leverage the biggest trends in the world. But more than that, it's the growth mindset and personal development that have transformed how I approach life and investing. Having a community of like-minded people to share wisdom, experiences, and lessons with has been invaluable. From finding tenants and growing a real estate portfolio to designing the life you want, it's been a game changer. Being part of the Inner Circle has completely changed my perspective on money and life. The insights I've gained have helped me make smarter decisions, and I'm now way more confident in my financial future. If you're ready to level up your investing, mindset, and your life, I can't recommend the Rockstar Inner Circle enough. It's not just a membership, it's an opportunity to design the life you want. Thanks for letting me share this with you, and I hope to see you in the Inner Circle soon. If you're curious to learn more, feel free to check out rockstarinnercircle.com/get-started for free resources and see if it's the right fit for you. Now back to the show.
Okay. Yeah. But yeah, so if you can build a fourplex for significantly cheaper on a per square foot basis, your land cost is higher, like where they're paying maybe $5 to $100 bucks a buildable square foot, you might be paying $100 to $200, but you make it all back on, you're not paying DCs, you're paying a lower construction cost because you're not building out of concrete, you're building out of wood, right? So to create a rental unit, you have a much lower cost if you're doing a fourplex or any other middle type housing type. And that allows you to be competitive when you go into the market and rent it out. You can make money at lower rents, right?
And also, is this protected a bit from those big developers, as in it's too small scale for them to do this themselves? Like, they're focused on those bigger projects, so it's like almost out of reach for them because of just the small scale. Like, does that give you a bit of a kind of moat?
Yeah, pretty much, to be honest. I would say for now, I think it wouldn't surprise me if we do start to see larger developers start to creep into this space a little bit, simply because they aren't making any money doing high rise, and they're not making any money doing low rise. And so, like, the only way to find, they have the problem where they need to find a market where their buyers can actually afford to buy the product that they're selling, right? And the only market in which they can do that, as far as I can see right now, would be missing middle housing. So we are seeing like a ton of interest. Like a lot of the people who have signed up to come to this event are big developers who are exploring this as because they have the skills. Like it's not like it's hard for them to. It's a way simpler construction. It's a way simpler zoning process. They know how to acquire the land, right? They just can't like. They can do it. It's just how do we do it at a scale that makes sense for a huge operation, like the companies that are putting out tens of thousands of units a year, right?
Why aren't they making money with low rise?
Because nobody's buying it. Like there's no demand, or there's not none. There's a little bit more demand for your ground-based brand new houses compared to high rise, but there's still like we're still trading at like 30-year lows on pre-construction sales, right? Like we're trading at 1996 levels, which I don't know if you remember the 90s. I wasn't around for it. I was born in the 90s, but anybody.
I was born in 1995.
There you go. So you were born in the last cyclical bottom of the real estate market in Canada, and we're now trading at the same level. So
yeah, and I was lucky enough to start investing in the next one.
yeah, there you go. So
yeah. Okay, so yeah, but is that Toronto centric though? When you're kind of rattling off how they're not making money on those as much. Like if you're outside of Toronto or even the GTA, are they having a bit more luck with these pre-construction sales selling low rise?
A little bit, but like we're still at like record lows for the GTHA, right? So like the whole Greater Golden Horseshoe is like we're 75% below peak volume. We're like 50% of the long-term average, right? So
okay,
we're not seeing supply getting created. We're not seeing demand for that, and we're not seeing supply getting created from pre-construction sales anymore.
Got it. So it's not just Toronto. The development charges, how much are they, to give people context?
It varies on a unit by unit basis. But I think like they just went up like, I think 50%. I think that's like $90,000 for your like average, 1-bedroom condo. I'll pull it up.
On a per unit basis, $90,000 approximately.
Let me pull up the exact ones because I don't want to be wrong here, but yeah, I think that basically like they end up being about like between 10 and 20% of the total cost structure of the unit that ends up being paid by the buyer.
Holy smokes.
Yeah. So the most recent one is from June 6, 2024. So let's go to apartments. Well, so singles and semis, 137,000. Apartments, 1-bedroom and bachelors. Actually, sorry, I misspoke on that when I was using the 2-bedroom. It's 52,000. 2-bedroom plus apartments is 80,000.
Got it. So it varies across units, but you could ballpark it at 10 to 20. Right. And what are they justifying charging that? Like, why do they, what's their justification for taking development charges? What does that even entail?
Yeah. So the idea is like they use this thing in quotes, growth pays for growth, right? So the growth pays for growth idea is that in order for the city to be able to make that unit exist, they have to put in water and sewers and parks and transit and blah, 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 all of these different things that apparently we have really good infrastructure for in the city of Toronto because you've been paying for it in your development charges. I think the average user of said infrastructure would argue that it might not be high quality, but that's what you're paying for. Basically, they're taking money out of from the purchaser of a property to pay for all of the infrastructure that property uses. And the reason that they do that is so that they don't have to pawn that cost off onto existing owners, because Toronto has some of the lowest property taxes in the world. And even though they're hiking the crap out of property taxes because they have another revenue problem to solve, it's not going to really make a difference. Now, the interesting part is developers said, stop increasing this. Like the buyers can't afford to pay it. We can't afford to build. Nobody's going to buy the units if we keep increasing the prices. And none of the cities stopped doing it, or the city of Toronto didn't. And now they're basically faced with zero revenue from development charges. So they kind of, they kind of shot themselves in the foot there. You are starting to see 905 municipalities start to scale back the development charges. Vaughan led the charge, which last time I was on the show, actually, I was talking, it was the day that happened, I think in November. And then Mississauga just announced recently that they're thinking of scaling back development charges by 50%. So these municipalities have basically realized that getting 50% of something is better than getting 100% of nothing.
Mm-hmm. I mean, the idea of that feasibly makes sense if you're building like a big subdivision or a big condo building, because you are putting so much density in that area that you do need, maybe bigger sewers or all the utilities or parks for those people to have some outdoor space. But if you're doing these as of right missing middle housing developments, it's like you're turning a single family home to 4, maybe 5 units. Like, it's not really as needed, I guess. So it kind of makes sense from that standpoint to remove them as well. Not to mention, you're obviously incentivizing that type of housing to be built.
For sure. Yeah, 100%.
Yeah.
I think we're now getting to this period where municipalities are beginning to realize their role in it. And we will start seeing concessions, like the concessions that Vaughan and Mississauga made are just going to continue from my perspective. So the cost structure for middle developers is only going to continue to improve. Okay.
So you kind of laid out the overall picture of why it works when you compare it to big condo developers and the costs associated. But what do the numbers on one of these typical deals kind of look like? Like, how would it break down?
So typically, I mean, to be honest, like if you're developing a 4+1, like your yield to cost or like your stabilized cap rate ends up being like in like the low 4s, if not like, I mean, so it's not super impressive, right? But it ends up working with concepts like CMHC's MLI Select financing, I would say is probably one of the biggest, because that takes the amortization and spreads it out over 50 years. So you're basically buying down your monthly payment by doubling the life of the mortgage, which I'm not super fond of that concept on its own. And I see a lot of people using it very recklessly for deals in other provinces and stuff like that. But for something like this, it makes sense from my perspective because you're building into a growth market like Toronto. You're building into like the market in Canada, right? Or if it's the Greater Golden Horseshoe or wherever, and you're doing an add value project. So you've basically taken something and you've built the equity into it through development. All of that to say, like the example that I just used is a 416 project. I've seen much more comfortable cap rates in the Niagara area, the Hamilton area, where people are doing this, and their yield on cost is like in the 6-7 range, right? So you're basically end up stabilizing at a 6-7 cap, which is great. Like that's an exceptional deal.
Yeah. And how viable is it in these communities? Do they have the same municipality law that it's 4 units as of right?
No. So some do, some don't. They're all kind of just catching up, right? Like I would say, I typically point people to Toronto to say like, Toronto typically will lead the charge on what's necessary from a policy perspective. And then usually the remaining municipalities, if they want to continue to see growth and not have that growth sucked out of them from Toronto, will need to keep up, right? And so that's where you're starting to see that take place in certain areas around Toronto. A lot of them have had concepts that were available, like your stacked towns, your townhouses, different other like larger scale infill concepts. So it's really just ends up being scaling it to be upzoned for some of these smaller lots, and you're starting to see it. And then at an Ontario level, because missing middle doesn't just include it doesn't have to just be like 4+ units. That just, the 4+ is really just to get you to that CMHC MLI Select, because for CMHC financing, you need a minimum of 5 units. That being said, there's a lot of really fascinating stuff happening in the 4 and below unit range from a financing perspective, especially for owner occupiers. So we're seeing this thing evolve where you have basically, it's become a house hack where people are basically buying a house and adding 3 units to it. And you can refi out up to $1.8 million now, based on CMHC's new program. So 90% of $2 million. And you can do not a 4 unit, but you can do 3 units on any lot in Ontario, right? On any residential lot in Ontario because of Ontario's Bill 23. So that's something that what we're seeing more commonly. And then if you take that scale, right, you go to like a St. Catharines as an example, who has the ADU program. So they have that ADU grant, plus you have the secondary suite loan program, which is the federal government will give you $80,000 as a mortgage construction loan, basically to add a unit. And then you do, again, like you do the St. Catharines ADU, and then you do your refi out. Now all of a sudden you've got a pretty good owner occupied program going. So we're seeing that pretty commonly, and we're seeing a lot of investors play in that space with 2, 3, 4 units, because it hasn't been as encroached on by the large players. I think 4+ is really like some of the groups that we're seeing doing it are really, really killers, right? And the 4 and below, it's not an easy space for the big groups to compete in.
How many of those types of projects are you seeing where somebody's renovating or putting an addition on or adding units into an existing structure versus knocking it down and building from scratch?
They're the majority of cases right now, because it's the only economical way to do it, with construction costs being so high. And hopefully this whole tariff thing, if there's one silver lining in this tariff thing, it's that, a lot of Canadian construction materials end up getting stuck in Canada, and we end up having a surplus of construction materials. And now all of a sudden we've got construction cost deflation in Canada. Honestly,
that's how we dig our way to the housing crisis. Trump
maybe. So, but yeah, right. As it stands right now, like if you could, let's say you can renovate a existing structure for like, I don't know, on the cheap end, $100 a foot, on the expensive end, like $200-300 a foot. Right. So, because the bones are already there. Whereas if you tear it down and build, you're spending $300-400 a foot. So in most cases, it often makes sense to buy the giant house and cut it up into multiple units, rather than tear it down and build. And that's like, we're encouraging a lot of people to do that more than anything else. Because the best part about that program is you can buy let's call it the land, or you buy the existing asset with residential debt. So your capital cost is way cheaper than if you're buying it with anything else. Plus you're getting construction loan at like 8 to 10% now, maybe over 10% right now. And then, you're building for a year, and then you have to refi out with something, and you expose yourself to a lot of market risk in the process. So the renovation is definitely more popular and achievable right now.
Okay. Yeah. So what we're talking about, this is different than kind of the missing middle opportunity that you guys are going to be talking about at your event.
Not really. No, I think our goal is to explore the, like, every single option, right? So we're kind of going to take it all the way from 2 units, which is the low end of missing middle. Like, it's basically anything between a single family home and a mid-rise building, right? So basically a duplex up to 6 stories. And we're kind of going to compare and contrast a lot of those, like the returns for what it looks like if you do 3 units or 4 units versus a 4+1 and go CMHC, MLI Select or whatever. And the reason for that is, they aren't all, or they don't kind of all work for everyone, and every investor is different, right? Their appetite is different. But the other piece is that a lot of the people who are interested in this, and a lot of the people who stand to benefit the most, are people who already own the real estate. And so we are really attracted we are really attracting a lot of, existing owners who have a giant house, have the McMansion, and they're like, I don't need this much space anymore. Or like, this thing's not going to cash flow if I renew it now at a 5% interest rate. So why don't I cut it up into 3 units? And that's been really common. And a lot of it is also owners who have owned sites where they can demolish and rebuild. They've owned the land for 30 years. And so their land cost basis is functionally zero, right? It's paid for itself a couple of times. And they basically can do the project, or they could maybe even vend in a builder partner and just, they bring the land into the deal, and they bring a builder partner on, and the builder partner pays them out as part of the return in the fullness of time. So we're seeing a lot of creative structure to try and maximize and kind of unlock the value of that's tied up in a lot of these sites in the GTA, because you have a ton of legacy landowners who don't know how to make the most out of what they are sitting on.
Yeah, very true. We shot a YouTube video maybe about 2 years ago at this awesome project that Craig Race had designed. And it was Leonid Kotov's project. He's been on the podcast. But it was in Toronto. I forget the specific neighborhood now, but it was in Toronto, and they took a single family home, 1 unit, knocked it down, severed the lot, and then built basically a connected structure, but 2 fourplexes and then garden suites at the back. Mm-hmm. And it was just this beautiful project. And they had some local Toronto street artists paint like a mural on the garden suite at the back to really make it pop and stand out. Beautiful project. And it was going from 1 unit to 10 units, right? Able to also apply for the CMHC MLI Select financing. So it was just like a beautiful example of what can be done, and created, to your point, units very similar to condo buildings in terms of their square footage, in terms of their appearance, their modern look, the size, the amenities, but in this really nice neighborhood in Toronto, which was very different than where some of these other high-rise buildings are in much higher densification. Like, it was just a great fit for everybody, for the tenants, for the investor, and for the city.
For sure. Yeah, 100%.
So it just showed me the potential of doing this. How accessible is this to the mom and pop investor? I know you talked about the existing landowner, but what about somebody who's listening to this? Maybe they've got 5 to 10 doors, 5 to 10 properties, and they want to explore this opportunity. How accessible is this?
For the exact person that you just mentioned, like if you've got 5 pins, let's call it, if you have 5 properties, maybe they're single family or duplex. I know you guys doing kind of like a lot of duplex stuff. It's pretty easy. Like it's basically just saying, okay, if I've got up down duplex with 2 1,200 square foot units, why couldn't it be a up down duplex or an up down fourplex with 4 600 square foot units? And the answer to the question is usually like, it could be, and it's going to cost me, whatever, $70,000, $100,000, $150,000 per suite to make that conversion. And then you just start your drawing packages, and whenever your tenant vacates, you do it. Or some people use it as an opportunity to vacate the tenants. I'm not really a fan of that, but it's part of the game, and a lot of people do that. Plus, the other piece is a lot of landlords with legacy assets are, some of the units are subject to rent control, right? So now all of a sudden, if you're adding new units, those new units aren't subject to rent control. So you can unlock a little bit more upside in your NOI, right? So for somebody who owns the assets already, and if they have, assuming they've owned them for some period of time and they're not over levered and cash flow negative and bleeding out, they probably would have a really easy time doing it. They could maybe pull a little bit of equity to fund the construction, or they probably have some cash laying around to fund the construction. Like, I'm personally in the category that you just described, and all of my free cash flow from my buildings and savings and equity is getting pumped into adding units to these, so that when rates come down and asset values are where I want them to be, I have added value and cash flow to all of my buildings, so that I can very easily tap them again, pull more equity out, have more cash flow to cover larger loans, and scale my portfolio. So I'm kind of preparing myself by adding incremental density to my existing portfolio for subsequent acquisition when the market's where I want it to be, which I'm expecting to be kind of 26, 27. I guess the other mom and pop investor, the kind of person who's in acquisition mode, it's a little bit more challenging, right? And I would because it is cash intensive. And so for those folks, I would say, start small. And if you can, if you're young, and I think most people who are just getting into real estate investing, they're young, maybe they're single, or in a couple, don't have a family yet, and huge space demands. Really look into the house hack avenue. Honestly, it's a super, super good way to to kind of create value, create equity, and capitalize on a couple of really good government programs, which is, CMHC just increased their owner occupied to 1.5 million. So it kind of makes Toronto accessible again to the first time buyer. And then if you're adding the units, you get, your secondary suite loan plus the ability to refi out that up to 1.8 million, assuming that, that you hit the metrics, not just like they just give you 1.8 million, but that's a really good way for somebody to scale. And then, whenever you're ready to leave that property, you keep it as a fourplex that you own or whatever, any plex that you own, doesn't matter what number. And then you go buy your primary when you need more space.
Yeah. What is your general advice for young Canadians that are struggling? They want to get into the housing market today. Obviously, you just laid out the house hack, but what about just renting? Like, how do you view those dynamics right now in Canada? Renting versus owning versus house hack. Obviously, knowing all the stuff you do about investing, you can be more creative. But for the average person who's wondering what to do, like, what do you think about all that?
Well, my advice to people who are in that position is like really have an honest look at yourself in the mirror and say, am I good at investing and saving money? And if you're not good at investing and saving money, then you should really, really be trying to get into buying a house, because the value that a house serves for most people is that it saves money for them. It forces them to pay the mortgage and it saves money for them. And it forces them to invest that money in a hard asset, right? Which is a house. If you're good at investing and you're good at saving money, honestly, renting is a far lower cost on a monthly basis. So I would say you probably should rent and invest your money in something smarter. If you take the capital or the opportunity cost of whatever you'd put your down payment into, so let's say you're buying $1 million house and you're gonna go 20% down, $200K, whatever you'd put that into. If you can, even if you're just in the S&P, you're 10% in the last.
Dan, you can say Bitcoin. It's all right. You can.
Yeah, Bitcoin, sure.
You can name drop it.
Yeah, Bitcoin, anything. Like, could literally be anything, right? And,
sure.
You can, if you, it's not that hard to outperform the real estate asset.
Yeah.
What makes the real estate asset good is leverage, right? So,
exactly.
Let's say if you put it into Bitcoin and then you dollar cost average every single interest payment that you would have paid into Bitcoin as well. Or any dollar that you would have saved on a net cost basis, between the difference between your rent and what your mortgage payment would have been into Bitcoin, you will do far better than you would if you just own the house. But the truth is, most people are not going to do that. Most people know they're not going to do that, and that's why they need the house.
Yeah. Yeah. And it gives people access to the leverage, whether they know it or not.
Yeah.
The leverage, the forced savings into a hard asset that happens to be pretty scarce and desirable right now in Canada.
Well, this is the thing, right? Like, I love Bitcoin and I love equities, but I can't live in Bitcoin or equities. And I also can't get government insured hedge fund level leverage in Bitcoin or equities, right? So not yet, at least, but maybe one day they'll give me that much margin. But if I want to go 20x levered into a house backed by the taxpayer, which is, I'm not happy with the moral hazard of that, by the way. Let me caveat with that, but like, I could do that, and I can't go to the taxpayer and say, hey, will you insure me to go 20x levered long into Bitcoin? That's just not going to happen.
Yeah. 100%. Yeah. And I think the 5% down, 10% down is a huge hack, especially if you can set up a house hack for yourself. And because trying to save your way to 20% down for the average young Canadian right now is tough. It's so tough. And then managing that monthly cost, like, the house hack is the ultimate thing. The one downside I would say is it's going to extend you out to maybe further communities than you ideally would want to live in, just with purchase price, right? And what you can qualify for. But it's a necessary sacrifice if you want to get in on that. Well,
and that's the thing. Like getting ahead in life is about making sacrifices and compromises, right? So, like, if it's, hey, do you want to achieve the financial goals that you wanted to achieve in your life, or do you want to live where you want to live? You can make that it's like it's a qualitative answer to the question. Some people choose door number one, and some people will choose door number two. It's not up to me to say who's right or wrong, but that's the trade-off in most cases, to be honest with you.
Yeah. So you said for your own portfolio, you're adding densification. So are you mainly focused duplexing? Are you adding garden suites? What are you specifically doing for yourself?
Yeah. So we have two, the one that we're on right now, we have two like side-by-side brand new bungalows with walkout basements. So we're going to add, and I'm not a pre-con guy, by the way, like those were contracted by my dad like 13 plus years ago. So kind of like a legacy asset. But we're adding basement apartments to those, and then they're side by side. So my brother and I own them together, and we're looking into putting a garden suite in. The lots are a little tight, so I'm not sure if we'll get it. But adding that fifth unit, because they're contiguous lots, right? So you can do CMHC, like you were saying with your guy there that did the 10 units. As long as the two lots are side by side, they'll count that as all of the units are connected, and so you could get CMHC MLI Select. So our goal is to eventually, as bond yields come down and rates get a little bit more compelling, put MLI on that, not with a 50-year AM, but probably like a 30 or a 40, but try and get that cheaper rate.
So they'll count the two duplexes side by side. So that's 4. And then if you add at least one garden suite.
Exactly. Yeah. So we would add just one garden suite just to get to 5. There's not room for 2. Or we'll end up adding just a third unit in one of the existing buildings. Yeah, so that's example number 1. We have another one up in like the kind of like Muskoka, rural Sudbury area. That's it's technically a 3 unit, but the third unit we've never used because it's just been in such rough shape. And we had never, when we bought it, we kind of just left it and whatever and said we'd get to it, and now we're getting to it. So that's another one. The portfolio that I was on with a group of investors that I built with Nick, my co-host on the podcast, and a group of I guess they're kind of the GPs in the project now. We've basically just been adding units to everything or improving the value by just cosmetic renovations. Again, just to be able to pull equity. So that's kind of the format in which we're doing it. I am like partnering on a lot of these 4+1 and other infill deals. But it's just, to be honest, it's out of scope for me. And I know that when I'm getting into it, like I can definitely help people acquire, but I'm not a project manager. I'm not, a planner. I'm not an architect. I'm not, a lender. So I kind of let the GPs handle all that stuff and really just focus on finding the deals and partnering my way in that regard.
Okay. Earlier you mentioned that you are looking towards 2026, 2027 for asset prices to be where you want them, for rates to be. So how do you see the next 2-3 years playing out? 2025, 2026, 2027?
Yeah, I've said for a long time that I felt that the next housing downturn in Canada would turn out to be exactly like the 90s. And so far I've been pretty damn right on that one. Which is, I guess I got fortunate on that call. But so I don't know if you saw the Rob Cavsick's analysis, the economist at BMO. He did a chart basically that shows all of the housing corrections in Canada's history side by side and where we are right now. We're basically like right between Ontario in the 1990s and Vancouver in the 1990s. And those were the two, like those are really bad housing corrections, really bad recessions. I would say we're probably going to end up following the exact same path that we did there. So we saw an immigration peak in 89. We saw an immigration peak last year. We saw house prices peak in 89. We saw house prices peak in 2022. They dropped about, 10, 15, 20% maybe. Then they kind of bounced back a little bit and then they dropped again. Same thing happened in 89. And then after that second drop, they kind of just grinded down a little bit as like the recession really took its hold. And the recession meant rising unemployment, lower household savings, more bankruptcies, more forced sales. Interest rates were higher because there was a bit of an inflationary impact, which could end up happening, honestly, as a result of the tariff setup, but I won't speculate too much on that one. And, basically 91 till the year I was born, 91, till the year you were born, 95, the house prices basically just grinded down like 1%, 2%, 3% until maybe more, maybe 5, maybe 10, depending on the market, until about 96. And then they started their very slow recovery. And it took until 2002 for house prices to get back to their 1989 peak. So that's quite literally what I'm expecting. And I think we're probably pretty close to the bottom right now. I would say there's probably another 5-10% downside in certain markets and asset classes. Condos are the one that I'm really watching. And I think condos can definitely pull the whole average down because there's so many of them and they're so much more cheaply priced by comparison to the whole average. So they can pull, like Toronto 416 condos can literally pull the entire national average house price down. So I would say there's probably, again, maybe another 5-10% downside risk based on that chart and based on what I'm seeing. That'll probably take place slowly. It's not going to wipe people out like it did in 2022, where like, if you bought in February and then sold in April, your spread was like 400 grand. That probably won't happen again, but it'll be slow and steady. The market will favor buyers more than sellers for the next couple of years. You'll see more distress selling. People are all getting to their ends. We know that we have tons of mortgage renewals coming up over the next 2 years. People are most likely to want to sell their property when they're up for a mortgage renewal, so they don't get hit with a mortgage penalty. So I would say probably 26. Look, if a good deal came across my desk right now, I'd buy it, but I just haven't seen any. Sellers are still pretty sticky on their pricing. They're still pretty unreasonable. You get the odd, like, optimistic spring market or fall market, and then they're back at their pie in the sky valuations again. So as I start to see vendors really getting realistic on pricing, I'm super fired up to be acquiring in 26, 27 based on everything I just said. I hope that explains or answers the question well enough.
Yeah, no, it gives a great kind of overview, I'd say. What do you think about if you just zoom out and you look at like 2020 pricing versus now? Maybe don't look at the condo market because that's obviously taking much more of a hit. But if you're comparing those prices till now, aren't we still up?
Yeah,
if
for
you
sure.
Zoom out and look at the bigger picture.
Yeah.
So do you see that still continuing to come down, or
I think that it could, based on the fact that like, people think I'm being bullish when I say there's equity padding in the market. Like, I put out this Bank of Canada chart and people are like, oh, there's or like it was showed that, like, the average loan to value is like 65%, or the majority of mortgages have like 65% mortgage. I'm like, lots of people have tons of equity padding, and people are like, oh, like, well, prices aren't set at the margin, or prices are set at the margins. I'm like, yeah, the point of this is that there's a lot more room for prices to fall without people really being super worried about it. You know what I mean? So, do I think prices could come back down? Well, yes. Do I think that they could stabilize and go back up? Also, yes. It really depends on how badly the policymakers in this country, the central bank and the government, want to devalue the Canadian dollar, to be honest with you. The only bull case left for Canadian real estate is devaluation of Canadian dollar. There's no other bull case. Like, you can't say it's rate cuts, it's employment, it's immigration. Like, they wiped all those out. Okay. They can't spend more money on hiring government employees. They can't immigrate. They can't increase immigration, right? They can't increase the student population anymore. They've, maybe they'll do some helicopter money stuff by the sounds of it with this tariff stuff. It sounds like they're pretty fired up to get some stimmy going with that. But that's along the lines of what I'm saying, right? Like, that's inflationary. And so, if the bull case for your asset is inflation, you're toast. Like, your country's toast. Like, I'm not saying that to be, like, oh yeah, we're, let's get on the rocket ship, baby. It's like, nah, this is a bad place for Canada to be. Yeah,
it's not a great thing seeing your house price go up when you know that it's just the currency being absolutely debased.
Right. Yeah, I totally agree. Like, but most people think, like, when I'm saying, prices could go up, it's like, it's funny because,
nominally. You mean nominally?
Exactly. Yeah, the nominal price could go up. Real prices, very unlikely that real prices will go up. But it's funny because it's like the same people who say, oh, we're going to see ripping inflation again, and the central bank's going to hike to 5 or like to 10. They think we're going to go through like another Volcker era, like in the 80s. Like, oh yeah, you're going to be paying 18% interest rates again. It's like, okay, cool. So in that scenario, like, any economy that warrants 18% interest rates is probably inflationary, which means house prices went up, and that's why TIF hiked us to 18%, right? And they're like, oh, no, house prices are also going to fall. It's like, well, I don't know. You can't get both, man. Like, I get it. I like being a doomsayer as much as the next guy, but like, get your shit straight, right? Like, you gotta, there's like, so that's my thought.
I guess it's like where the money comes into the economy. Cause it's like, growing up my whole life, house prices just grinded up, right? Because it was predominantly asset inflation, especially after 2008. And then of course, as soon as I start buying, pandemic happens, and then it's consumer inflation because everyone was paid to stay at home and sent stimmy checks. And so we saw consumer price inflation, and it's like they never raised rates to combat this asset inflation we've had for decades. They only raised it once everybody's groceries started going up. So I guess it would depend too, like where that money's hitting the economy.
Yeah. So from my perspective, like, it's really easy to see because, the Bank of Canada with their rate cut yesterday, they did two very interesting things. One was they ended QE or QT. So, next is probably QE. And number two is that they released their monetary policy report, which kind of forecasts that they are most concerned about balancing the impacts of the tariff, because there's the inflationary impact of if Canada goes trade war, then prices jump up and that's inflation. There's the demand destruction force of if they do that, then people can't afford shit anymore and they stop buying it. And now that the economy is disinflationary or deflationary as a result. All of that to say, if they go QE, QE in Canada is so much different than QE in the US, and it's simply because we don't have a diverse economy. So in the US, if I'm the government and I want to do QE, I can buy bonds from Bruce Chris Steakhouse. It was like the first one that was rescued during the bailouts, right?
Really?
Yeah. It was the first one. It was like they were about to go, belly up because of COVID shutdowns, and that was like the first bond purchase from the COVID QE. The whole phase of COVID QE. Like QE was great during the 2008 recession. It was a huge revenue generator for the government, right? They ended up with bonds from some of the best, most stable American businesses, right? All the banks, automakers, et cetera. We don't really have that in Canada. Like, who are they gonna buy bonds from? RBC, TD, Scotia, BMO, et cetera. Maybe the telcos, but probably not. Maybe they're your utilities infrastructure companies. Okay, so like set aside the telcos and ISPs, because like whatever other oligopolies we have in Canada. So assuming they buy from your banks, what are the banks doing with the money if they end up getting selling bonds to the Canadian government? They're giving it to you and me to buy houses at a cheap. Mm-hmm. So that's the easiest way for them to increase liquidity, right? And liquidity is drying up right now, but banks don't want to lend money to anybody because the risk environment's too high. So that's kind of phase number one. Phase number two is, again, we use the example of utilities infrastructure companies, which I honestly don't think they're actually doing QE in that regard, but let's just hypothesize that they did. It's the same thing. What are they doing? Oh, they're going to put infrastructure in, which is going to go to houses, right? So like, we don't really have, like, we have a little bit of oil and gas, et cetera. And hopefully when we see a regime change in the Canadian government this year, you will see a shift to, the government going more, or policy going more in favor of diversifying into those ends of the economy, as well as like commodities. Commodities are ripping right now, battery metals, et cetera. But until we do that, our economy is reserved to basically building houses and lending money to people who build houses. And so the Bank of Canada has a limited scope on what they can actually pump money into. In the US, they can pump money into a lot of stuff. In Canada, they can't.
So your bullish case for real estate would be that currency debasement having to happen and that going into the real estate market, because what the hell else does it go into?
There's no other place for currency to end up in Canada, really. Like, honestly, I don't know. Like, I would love for somebody to tell me another place that like billions and billions of dollars can end up in a meaningful way. Like, but it can't. And even if it wanted to end up in like gold mine projects or whatever, those are like 5 years of bureaucratic red tape before they get in the ground. So it's not instant enough to be like, a real investment. Like, there's no trade there, right? Yeah. Okay, buy houses in Kirkland Lake is probably the trade, right? Like,
yeah. And how much residual like leftover income or equity from investors is going to be going into like the TSX versus just the American stock market. Right. So there's not even like some downstream effect of that. Right.
Yeah. So I think that, the central bank in Canada has kind of just got their hands tied, and they know that once they like, every presser, the majority of questions are like, are you watching the housing market? They're like, yeah, obviously we're watching the housing market. Like, like, yes, like that's probably our primary thing. Like, anyway, the whole thing's fascinating from my perspective. The TIF's in a rough spot, man. Like they've really, and tariffs are only going to make it a lot worse.
Yeah, it's kind of like between a rock and a hard place right now. Do you think the Bank of Canada only really started paying attention to housing prices after the pandemic because of what happened? Like, it just seems like they didn't care as much before that house prices grinded up steadily from like 2010 upwards.
Well, I think it was not so much their policy that caused it before. Like, I think that when they dropped the overnight rate to 25 bips in early COVID, it was clear because, let's go back to like 2016 2016 Vancouver huge run up in prices, right? And then they put in their foreign buyer ban, and prices crashed right back down. So that showed you, okay, that it's outside of the scope of monetary policy that can fix this problem, and it did, right? It was a problem with foreign ownership being attracted to Canadian real estate, and you could fix that with that tax. Then same thing happened in Toronto, right? 2017, the Ontario government, put in the non-resident speculation tax, and OSFI put in B20 as well around the same time. So it was like two hits. There was there's B20 round one, which was first-time buyers, and then there's B20 round two, which was all buyers, when that happened in January of 2017. And then in April of 2017, there was the non-resident speculation tax that made it so that Ontario foreign purchasers had to pay a tax of 15%. And that crashed Ontario prices like what, 20%?
Yeah, and sorry, when you say OPSI, you're referring to the stress test, essentially?
Yeah, B20 is the stress test. Yeah.
Got it.
So the stress test came in. So, and those things all did a pretty sufficient job. Like I honestly would be willing to say that and I did say this many times in 2017, 18, 19, like that 2017 would have been the long-term peak of Canada's housing market. Like, and it would have been very easily regulated away simply by fiscal policy, government, just like legislative, the kind of the government, not the central bank, right? And then COVID happened. And when COVID happened, monetary policy came into play in a very big way. And you give Canadians freaking cheap rates and high leverage and some stupid credit product to just YOLO on. Look at it with CMHC MLI Select right now. They've literally turned it into a speculative vehicle to overbuild Alberta sixplexes right now. Like, you know what I mean? So you give Canadians a way to YOLO on some ridiculous credit product, and they're going to do it, man. So they did. And TIFF realized that too late, honestly, a year too late.
Oh my God, way too late. It was like, are they ever going to raise? This is crazy. Like, it was almost
I think they were waiting for the Fed, right? But it ended up being not mattering because Canadian dollar's toast anyway. Like I think they were worried about getting too far ahead of the Fed with the Canadian dollar.
True.
And they, in hindsight, I wish they did, man, because it freaking would have been the buying opportunity of a lifetime. I mean, I ended up loading a bit at like 78, that, and now what? Yeah, that's a 10% trade right there. But if we were a little higher, I think we were in the 80s for a little bit actually during COVID. Anyway.
I kind of remember in 2019 prices grinding back up to like that 2017 peak.
It was picking up, but they weren't getting up. Like COVID brought them back to 17. I think it was like till at least maybe in your market, but like, the ones that were really worth watching, like your Oakville, whereas like a lot of the luxury, like Chinese money where they really, Oakville, Aurora, they dropped like 40%, right?
To be fair, I'm talking like St. Catharines, Niagara, which is where I was investing.
Yeah, so a lot of those entry level deals for sure, because housing affordability was still a problem, right? And B20 made it more of a problem because now your mortgage payment became more expensive, right? Even if you're buying at a 3.5% rate, you're getting stress tested at a 5% rate. So you had to go buy in St. Catharines, so you're probably competing with the marginal buyer in those cities. Yeah. Right. So that's why entry level will always be like, I think the price floor, like, the closer you get to the bottom end of the market, the more stable it is, right? Like there's always demand for affordable housing ownership. Yeah, Tom and Nick have always preached that for years here at Rockstar, which is like the starter home market is the most stable. It's going to be the most liquid. Up markets, down markets, it's where you can get in and out much more nimbly, much more quickly, because there's kind of always demand. Down markets, people are downsizing. Up markets, people are always trying to get into the market. There's always a new generation coming up that needs a place to live. Yeah. So that always stuck with me. I want to talk about your event just to wrap here. What can people expect? I'm going to be there. I think Aiden Thompson as well is going to be there. So I'm looking forward to learning about this stuff. What can people expect? Tell us about the event, and Akram as well is you called him the middle housing. So why does he deserve GOAT status? Yeah. Well, yeah. So Al Karim actually, like he's developed a lot, like hundreds of units, I think, of missing middle housing in pretty much every Canadian city, like, and if he hasn't done it, he's helped developers do it in those cities. From Winnipeg, Calgary, Edmonton, et cetera. But he also helped several municipal governments actually write their fast track policy for missing middle housing. So he's super familiar on what the policy world looks like and how to get through that kind of like, and to me, like one of the easiest ways to be a really effective developer is be super efficient at cutting through bureaucracy. And he, I would say, is probably among the best at that because of his experience and being kind of participating in the bureaucracy, right? Advising people in how to come up with these policies. He's one of the most prominent developers in Calgary. They're in the CMHC's Housing Supply Challenge. So Middle, who we're co-hosting this event with, is one of the finalists in CMHC's Housing Supply Challenge, which is basically this competition to deliver housing supply. You know, there's many notable names on the list, and so we're kind of doing this with them in partnership of the efforts that they're doing to realize that housing supply challenge. What should people expect to learn? I would say if you take a raw piece of land or a piece of land with a house on it in any 416, 905, even 705 or 519 areas, basically pretty much any of the markets that were within a driving distance of Toronto, take a piece of land with a house on it, with or without a house on it, and you want to turn that into a missing middle housing concept, duplex, triplex, fourplex, all the way up to a 6-story building, you're going to learn how to do it at that event. Everything you need to know from site acquisition to planning, architecture, design, financing, construction, project management, lease up, and take out stabilization, and potentially even selling it. So you'll leave knowing exactly if this is a product type you're interested in. You'll leave knowing exactly how to deliver it.
Okay. And sorry, when is the event? I don't even know if we covered that.
Right. Yeah. February 21st, and it's 9 a.m. to 4 p.m. So it's, and there's a code for anybody who's a Rockstar member, listener to the show. The code is realist 025. So I think it has realist 025 for a discount. So we basically locked in the early bird price for you guys for the events, because I've always loved coming to your events. You guys have always supported us at ours, and we love to have. I think we got a lot of crossover between our audiences, and we always love to have the Rockstar crew show up at the stuff that we're doing.
Yeah, it's funny. The other day we were looking at our podcast and we just switched kind of from SoundCloud hosting to Spotify hosting.
Nice.
We're just looking into things, and we saw that you guys were like the number one related podcast to us. It was like, hey, if you listen to this show, you might like this one. And it was you guys, and then some other real estate investing ones, and then basically all Bitcoin ones.
Yeah.
Which we were proud of.
Yeah, that's great for sure.
Yeah. So cool. So you said, sorry, Feb 21st?
Yeah, February 21st. It's a Friday. It's downtown Toronto at the YMCA, and it's So, and we've locked in the early bird price ticket for anybody Rockstar. So if you guys want to just get that out to your audience, we'd love to see them there. Okay,
and it was realist 025.
Yeah, I believe I'll just make that a code, even if it's not, because but I'm almost certain that's it. Yeah.
Okay, Realist 025. You can catch Mr. Daniel Foch and his partner Nick Hill, both who have been on the podcast before as well, on the Canadian Real Estate Investor podcast. Investor, right?
Yeah.
The Canadian Real Estate Investor podcast. Dan's got a great Instagram, great X/Twitter account as well. Anything else you want to shout out, Dan?
No, honestly, just thanks for having me on. I love what you guys are doing. I'll support it always. So I look forward to finding more ways to work together.
Yeah, likewise, man. Always a pleasure, and it was great getting to chat with you here myself on this one.
Yeah, likewise. Thanks, man.